Hey guys, it's Chris Wong. I'm filming this video as of June 23rd, 2025, and I'd like to talk about the mindset of comparing the difference between credit card interest and some ETFs that I own myself. So the ETFs I'm going to be talking about briefly are HHIS, which is by Harvest Portfolios, and it's in Canadian dollars. And the other two I'll talk about is SPYT and QQQT by Defiance, which is in USD. So as a disclaimer, I'm not a financial advisor. I'm just a guy who's interested in trying to improve my portfolio and trying to achieve financial independence, retire early. So a thought just came up to me about credit card interest. And credit card interest, if you don't pay your balance, is like 20 or 25%, depending on your credit card company that you use. So when you are charged 20% interest for unpaid balance, so that's an expense to the consumer who used the credit card, but then to the credit card company, that is interest revenue. So I myself, I'm not really knowledgeable about credit card companies as I don't work for a credit card company, and this is just what I think how the business works. There's a lot of talks on YouTube about how high yield dividends they're not good for total return, or that they're going to go down long term, they're going to cause NAV erosion. But I just had a different thought because I was comparing to credit card interest. So HHIS, which is by Harvest Portfolios, it pays around a 25% dividend yield, but also depends on what the share price is. And I myself, I would feel comfortable to live off of the dividends of HHIS. Now, it doesn't mean it's the only holding I'm going to have, but I would feel comfortable to use the majority of the dividends to pay for my expenses. QQQT and SPYT, they are by Defiance ETFs, and they are based on the indexes, the NASDAQ 100 and the S&P 500. And their main goal is to have a 20% dividend yield every single month. But the dividends every single month, they change a bit because the 20% is going to be based on the share price when they pay out the distribution. So now I was thinking about credit card companies' interest revenue on charging 20% interest for each customer who didn't pay off their balance. The balances are going to be different every single month. At times the customer is going to be paying down the balance, so then the interest revenue is going to be less the following month, or the balance is going to build up and then the interest revenue is going to be higher. So the 20% target for the dividend yield for SPYT and QQQT. I myself, if I was American and not getting withholding tax like a Canadian in my TFSA or my margin account, I would feel comfortable to live off of most of the dividends for SPYT and QQQT. And I even compared these two ETFs with the actual indexes on the Dividend Channel website, and the total return seems to be similar, even though it does seem to be a little bit less than the actual index itself using $10,000. It's just, I'm not concerned about like if it's off by $100 or $200 off a $10,000 calculation, but the total return or the ups and downs seems to go along with the actual indexes. So I would actually feel comfortable to live off of those two ETFs myself. Now, this is not financial advice. I'm not telling you guys to live off of those three ETFs, HHIS, QQQT, and SPYT. This is just how I feel myself personally about being able to live off of majority of the dividends for these three ETFs if I were to hold a big portion of them. But I would also hold other ETFs to try to build up my portfolio and to be able to live off of the dividends from the other ETFs. I know for my safer ETFs, I try to aim for around 12% dividend yields from my Canadian portfolio. But with the 20 or 25%, you actually don't need as much capital to get the same amount of dividends. And I think that's the reason why like a lot of people, they want to invest in the super high yield dividend paying ETFs. But then there's a lot of people on YouTube that say that these super high yield dividend ETFs are not good. Your total return is not good. There's NAV erosion, and you're never going to beat the actual stock or the actual index itself. Investing in ETFs that pay weekly or monthly distributions, it's more than just aiming for a total return in order to try to achieve financial independence, retire early. It's supposed to help improve daily expenses, to generate the income, to help train ourselves for spending less than the income, and to reinvest and buy other ETFs, to have a long-term or a lifetime approach for investing. The dividends from HHIS, SPYT, and QQQT, I do think they're going to be paying out every single month. No dividends are going to be missed, and I do think the capital that you originally invested, it's going to still be there, whether it goes down a bit, but the dividends make up for it. And as long as you have the right mindset to live on the dividends only and not touch the original investment, then I think it's going to be an easier lifestyle to live off of those dividends. I hope you guys liked the video. If you liked the video, please give me a thumbs up. Otherwise, please subscribe to my channel for future videos. Thank you guys for watching.